Hello, this is Dr. Moultrie. We will continue with fundamentals of corporate finance. This is chapter six, which deals with bonds. Now, chapter 6 introduces bonds and applies our valuation tools to analyze them. Essentially, bonds represent loans. And when an investor purchases a bond from an issuer, they are essentially lending money to the bond issuer. Bond issuers are diverse and they include both federal and local governments, which issue bonds to fund extended projects. Also, numerous companies issue bonds as a component of their debt financing strategy. So in this video, we will discuss bond terminology, zero coupon bonds, why bond prices change, and we may get into corporate bonds. The learning objectives are understand bond terminology, compute the price and yield to maturity of a zero coupon bond, compute the price and yield to maturity of a coupon bond, analyze why bond prices change over time, know how credit risk affects the expected returns from holding a corporate bond. So as a review from chapter 1, again, we know that a bond serves as a financial instrument that is issued by governments and corporations to secure immediate funds from investors with the commitment of future payments. The specific details of the bond, including the amounts and scheduled dates of all payments, they are outlined in the bond certificate, as you see here on the screen. Now, payments continue until the bond's final repayment date, which is referred to as maturity date. The duration until the repayment date is termed the bond's term. Here you see in figure 6.1, here is a picture of a bond, a bearer bond, and its unclipped coupons issued by Elmira and Williamsport Railroad Company for $500. So you see the certificate and the coupons there on your right. So bonds typically provides two types of payments to their holders. The principal or face value, also known as par value or principal amount, it represents the notional amount used for computing interest payments, and it is usually repaid at maturity. Commonly denominated in standard increments such as $1,000, a bond with a $1,000 face value is often referred to as a $1,000 bond. Also, some bonds commit to extra payments known as coupons. Now, the bond certificate typically outlines the periodic payment schedule for these coupons, and sometimes they're issued semi-annually. So they are issued until the bond's maturity date. As you see again in figure 1 is an image of a bond. Bondholders would clip off the next coupon on payment date and they will present it for payment. So that coupon is what you see at the right. Consequently, the interest payments on the bond are term coupon payments. Now, although the majority of bonds are electronically registered today, the terminology persists. The amount of each coupon payment is determined by the bond's coupon rate set by the issuer and specified on the bond certificate. The coupon rate of the bond establishes the amount of each coupon payment. Issuers, they set and declare this coupon rate on the bond certificate. Now, as a convention, the coupon rate is expressed as an APR, which is annual percentage rate, and the calculation of each coupon rate is denoted as what you see here in yellow, CPN. And that is determined by the coupon rate. For example, you see here a $1,000 bond with a 10% coupon rate and a semi-annual payment will pay coupon payments of 10% times $1,000 divided by 2, and 2 is the semi-annual payment, which will give you $50 every 6 months. Here is just a table of the review of bond terminology. You have the bond certificate, which states the term of a bond as well as the amounts and dates of all payments to be made. The coupons are the promised interest payments of a bond, usually paid semi-annually, but the frequency is specified in the bond certificate. They are determined by the coupon rate, which is stated on the bond certificate. So the amount paid is equal to coupon rate times the face value over the number of coupon payments per year. The maturity date is the final repayment date of the bond. Payments continue until this date. The principle of face value is the notional amount used to compute the interest payment. It is usually repaid on the maturity date, also called par value. And the time remaining until, well, the term is the time remaining until the repayment date. Okay, we have here an assignment 1. It's a problem that we're going to solve. So assume that a bond will make payments every 6 months as shown on the following timeline using 6 months period. What is the maturity of the bond in years? What is the coupon rate as a percentage? And what is the face value? So there's 3 parts to that. So let's deal with A first. What is the maturity of the bond in years? So the maturity of the bond is the number of years until the issuer returns the face value to the buyer. For the case of a bond that will make payments every 6 months, the maturity is the number of payments divided by 2. So what is the maturity of the bond? The maturity of the bond is what? 10 years. The maturity of the bond is 10 years. So how do we get that 10? The maturity, again, is the number of payments divided by 2. The number of payments, as you see, is 20. 20 divided by 2 is 10. So it'll be 10 years. To answer B, what is the coupon rate as a percentage? So we can see that the bond consists of an annuity of 20 payments of what? $20.72 paid every 6 months, and one lump sum payment of $1,000 face value in 10 years. In 10 years. So you have 26 months periods. So we can rearrange the equation to find the coupon rate, knowing that the coupon payment of $20.72, where CPN is the semi-annual coupon payment. So when we rearrange the equation, as you see, we will come up with okay. The coupon rate is 4.14%. That's the answer to B. What is the coupon rate as a percentage? Is 4.14%. So to answer C, what is the face value? Of course, we know that the face value is the principal of the bond, which has to be repaid at maturity. So therefore, the face value is $1,000. And it's already there for you. $1,000 is the face value. Zero coupon bonds. Zero coupon bonds. Now, not all bonds involve coupon payments, and those without such payments are known as zero coupon bonds. So as the most straightforward type of bond, let us begin our analysis with them. We know that investors in zero coupon bonds only receive a cash payment equal to the face value on the maturity date. Treasury bills, U.S. government bonds with a maturity of up to 1 year, they fall into this category. So the overarching term for risk-free zero bonds is what we call STRIPS, STRIPS, which stands for Separately Tradable Registered Interest and Principal Securities. Separately Tradable Registered Interest and Principal Securities. STRIPS. When purchasing and holding a zero coupon bond, only two cash flows are involved, only two. Initially, we pay the bond's current market price at the time of purchase, and subsequently, at the maturity date, we receive the bond's face value. So to illustrate this, let's look at the screen here. Let's consider a 1-year risk-free zero coupon bond with a $100,000 face value, price at $96,618.36 initially. Now, if this bond is acquired and held until maturity, the cash flows would unfold as you see here on the screen. Despite the absence of direct interest payments, as an investor, you will receive compensation for the time value of your money when purchasing the bond at a discount to its face value. And as we discussed in Chapter 3, the present value of a future cash flow is inherently lower than the cash flow itself. Consequently, before reaching its maturity date, the price of a zero coupon bond is consistently less than its face value. Therefore, zero coupon bonds are always traded at a discount. It signifies a price below the face value, and they are also referred to as a pure discount bond or discount bonds. Now that we have a grasp of the cash flows associated with a zero coupon bond, we can compute the rate of return by purchasing the bond and holding it until maturity. As we discussed in Chapter 4, the rate of return for an investment opportunity can always be determined as the discount rate that equates the present value of the investment to its cost. So in the case of a zero coupon bond, the price stands as the cost of the bond. And hence, the rate of return on the zero coupon bond is the discount rate that aligns the present value of the future cash flow received, for example, the bond principal, with the cost of the bond. So this concept can be extended to a coupon bond, where the rate of return is the discount rate at which the present value of all cash flows from the bond equals the bond's price. The rate of return for an investment in a bond is specifically termed the yield to maturity, or simply the yield. So you see the acronym YTM, which is yield to maturity. I'm going to stop here and I'll start another video. For example, 6.1 yields for different maturities.